Well, welcome everyone to our next general session of the day. On this session, we're going to talk about the presentation of performance of the new marketing rule, and we'll sort of do a deep dive on some of the issues that are raised by these provisions. And we're really fortunate to have with us here some really outstanding speakers. We have Lance Dial, who's a partner at Morgan Lewis. Joining Lance is Michael McGrath from K&L Gates. And then we also have Linda Shirkey with Bates Group. So thank you all for agreeing to present here today. I am Sanjay Lamba. I am with the Investment Advisor Association, and I'll be moderating today's discussion. Next slide, please. So these are the topics that we decided to focus on. I mean, obviously, there's a lot under the new marketing rule, a lot of provisions relating to performance, and a lot of issues that you're going to have to think about. And our last panel sort of touched on some of them. But as we sort of talked about this session, we really wanted to sort of give you some of the issues that we think are the most pressing and some of the ones that we've been getting a lot of questions on. And so we'll start off by doing having a discussion on gross and net performance. And then we'll talk about the new prescribed time periods, the 1, 5, and 10. We'll then talk about related extracted. And as was discussed on the last panel, hypothetical performance, which for some of you might be a game changer. Then we'll talk about portability of predecessor performance, and then we'll sort of round out the discussion by talking about some of your record keeping obligations. So before we get started, I do want to remind everyone that this session is eligible for continuing education as well as IACCP. As we did on the last one, throughout the presentation, I will be giving you some 2 code words. And I'll go ahead and give you the first one, which is November, which obviously relates to your November 2022 compliance period that will be coming up. So with that said, why don't we turn to the next slide? And Lance, I'll turn it over to you to talk about the new gross and net fee requirements.
Sure, happy to do it, and welcome everyone. Thank you all for coming. As Sanjay said, we're talking about performance under the new rule. And one of the big changes in the new rule is the elimination of the one-on-one permission to use gross of fees. So net of fees performance is always now required. This is something that's an impact to the institutional channel, because for years, institutional advisors have said, or advisors to large institutions have said, that their institutional investor clients don't care about net of fees. The fees are highly negotiated and they're bespoke, and so the only thing they care about is gross of fees. So a net of fee performance is not relevant to that presentation. And for years, the SEC went along with that until now. And so now they've said that presentation of gross of fees could be misleading. And so they put in a standard requirement that net of fees is also always required. And so what does that mean? Well, gross of fees is performance results before the deduction of fees and expenses a client paid or would have paid in connection with the advisor's investment advisory services. So one point to note there, the or would have paid clause in that definition brings in hypothetical performance. So hypothetical performance is subject to the requirement for gross and net of fees. The other thing to note is that it's in connection with advisory services. What that means is that allows you to deduct transaction fees and still be considered gross. So on the net side, net performance is a similar definition. Performance results after deduction of fees that a client paid or would have paid in connection with advisory services. Here you can also include you can also exclude your custody fees for that net of fee performance. There's some requirements for the presentation, and they're listed right there: equal prominence, same time periods, same methodology. The idea here is to get an apples to apples comparison among the gross and net of fees. And so if you hit those 3, you're going to be okay on the prominence side. One of the challenges I think that the new rule creates, it's a benefit and a challenge, is there's no prescribed disclosure. I think you'll hear as we go through some of this that this rule is very principles-based. And principles-based regulation is one of those things that sometimes you have to be careful what you wish for, because it comes with compliance burdens. And so it sounds good, but when you look at a gross of fees and net of fees presentation, you'll need to understand all things like the facts and circumstances relevant to the investors, the material conditions, whether reinvestments were dividends were reinvested, and other material facts. That may be more of a burden than just following your rote disclaimers that you had before. Now, that doesn't say that you can't look back at prior practice and prior SEC guidance and glean something from that about what good disclosures look like. But it does mean that there's more burden on your compliance side to really think about what those disclosures look like. The last point I'll talk to about gross and net is model fees. So model fees have always been okay, and they're okay now. And there's a slight change to the model fee disclosure, and that is that it's the highest fee charged to the intended audience. Prior guidance was it's your highest fee actually charged to investors. So this intended audience is a new standard, and it comes with a trap for the unwary. And that is you have to establish who your intended audience is. And as we'll learn later, make sure you keep records about that intended audience. And the other thing to look forward to is how consistent the SEC requirement is with the 2020 GIPS standards on the same model fee presentation. So that's the high level of the management fee provisions of the performance rules. I don't know if anyone else has any thoughts on the panel.
I was just going to ask Lance, why the change on the institutional side, do you think? Because it sounds like that really wasn't, there wasn't a hue and cry from the institutional market saying we want to see net. What do you think?
Yeah, so in fact, I know that there was at least one person, one entity that went and said that exact question. Look, in the institutional side, we don't need net to show net performance, and it's irrelevant. The SEC talks about that in the adopting release, and their concern is that it could be either not controlled on the distribution of those, and it gets into the hands of the gross of fee performance gets into the hands of people that it shouldn't, or it's just inherently misleading, and there's not a huge burden with subtracting the net of fees performance. So why not get that benefit of clear disclosure while also making sure that investors are protected with not a huge cost. At least that was their thinking.
Thank you. That's helpful.
Lance, I have a question, an unscripted question.
Oh dear.
Do you anticipate that managers will have trouble satisfying the prominence requirement that is required if both net and gross are going to be shown?
I don't think you'll have problems with the prominence requirement. I think the challenges will come in incorporating a net of fees element to presentations where you historically haven't. And so you might have to find out what your model fees are. Sometimes you don't have model fees. So you have to figure out what your highest fee was. There's some work and compliance that goes back into that, proving out that that was a model fee. But as far as prominence, it may be an extra page that goes into a slide deck that has everything put next to each other. But I think people will be able to satisfy that fairly readily. In fact, easier than going through some of the rigmarole of figuring out what that model fee should be.
So Mike, Lance alluded to the GIPS standards. I know this is an area that you've been sort of focusing a lot on. What are some of the issues that you've been seeing with respect to GIPS and model fees?
You know, this, I think that there's a lot to like in the new marketing rule. I think that there is a lot to dislike in the new marketing rule from the perspective of different types of managers. But the treatment of model fees is a bit of an unfortunate outcome, because under the SEC's prior standard, which was articulated in the JP Morgan no action letter, if a firm was going to use model fees, they had to use model fees that were keyed to the highest fees that were paid by clients in the strategy. And under the prior version of the GIPS standards, the 2010 version, a firm could essentially choose a model fee that was relevant to the recipient of the presentation. And in the marketing rule, the SEC came around to seeing things the way that GIPS used to see it, and recognized that it would not be misleading to show a certain class of clients net performance based on the model fees, or based on model fees that are the types of fees that those clients would pay. And at the CFA Institute, the people responsible for GIPS thought to themselves, we should really harmonize our requirements with the SEC's requirements. And in GIPS 2020, they said you have to use the highest fee. The two talked to one another about a lot of things, but this was missed. So they flipped. And now we're in a situation where firms that pay or that claim compliance with GIPS will need to calculate in their GIPS reports if they're using model fees, net performance based on the highest fees paid by clients in a particular strategy. But they would also be able to show supplemental performance information on those reports or performance elsewhere in the presentation that is consistent with what is now the more permissive SEC approach.
Great. So Lance, Linda, do you have anything else you want to add with respect to presenting gross and net of fees? Okay, so why don't we move on to the next slide? And I'm sorry, I failed to mention at the outset, please do feel free to type in your questions. We will try to answer them at the end, but I really would want to make sure that we sort of get through all the materials and all the issues that we want to highlight for you. But again, as a reminder, on our next session, we'll have a panel devoted purely to answering your questions. So you could also hold on to them for that session as well. So Linda, so one of the things that was sort of new under the new marketing rule is this requirement to put in 1, 5, and 10-year time periods, performance periods, anytime you present performance. So what are some of the issues that you've been hearing about with respect to this new requirement?
Well, as Lance was talking about earlier, in terms of net and gross having to be shown with the same prominence, you have the same requirement here. So this isn't saying that you can only show 1, 5, and 10-year intervals, but you have to show at least those. And when you show them, they all have to be shown with the same prominence. So there has been an FAQ about this in terms of, wait a minute, what if we're not in place? What if we don't have 5-year numbers, we only have 4-year numbers. So you can show the longest period that you've been in operation if it's less than any of these, but you have to show at least as many of these as you can. Again, you can show different intervals. This is consistent with the 33 Act Rule 482, which requires that investment companies report 1, 5, and 10-year intervals. So this is a way to really align the non-RIC companies with the investment advisors to be sure that performance, that everything is comparable. And there was excuse me, I misspoke. The FAQ that's been released allows for 30 days after the fiscal year end to show your prior year numbers. So they're not expecting on January 1 for you to be able to produce your last year's numbers. And then interestingly, and I'm curious about what Lance and Mike have to say about this, that private funds are exempt from this. So why do you think that's the case?
Lance, mind if I take this one?
Sure.
So, Linda, as you might imagine, there was a real question as to whether it makes any sense. In my view, it makes no sense to show IRRs of private market strategies on a 1, 5, and 10-year basis. It makes more sense to show IRRs since inception. And rather than try to define the types of strategies or to find some definition for circumstances where IRR would be a better and a more meaningful metric than time-weighted returns or across time intervals, the SEC appears to have elected to exempt private funds because most private market strategies are managed in private funds, and very few private market strategies are managed in a separate account type format and sold advisory services. The problem that we have is that some are, and if you are a manager that is managing private markets type strategies and you want to show since inception IRR, you can, but you also have an obligation if you're marketing them as advisory services to present performance in 1, 5, and 10-year intervals. My personal view is that manager may want to add some disclosure to say, please take into account that these might not be meaningful in the same way that they would in other contexts.
Thank you.
Yeah, I'll just add that in the adopting release, they just kind of conclusory said that requiring advertisers to present performance results on private funds over 1, 5, and 10-year period may not give investors with sufficient information. And I'm not sure that I was necessarily compelled by that, but that's what they said and what they leaned on.
So when we were talking about this among the three of us panelists, there, Mike, you made a comment about having to use the fair and balanced reviews if you're showing the 1, 5, and 10-year intervals on different pages. Can you talk about that a little bit?
Yeah, I have found that there is some confusion out there with respect to what this prominence requirement means for 1, 5, and 10-year intervals. And you know, candidly, one of the reasons that I asked Lance the question that I asked was to set up this discussion here. So it's important to understand that anytime a manager shows gross performance, the manager needs to show net performance in close proximity and with equal prominence to that to that gross performance in a way that facilitates comparison. By contrast, when you're showing the 1, 5, and 10-year intervals, 1, 5, and 10 need to be presented, as you said, with equal prominence, but there's no obligation to show these reporting periods every time that you show performance. And a manager that, for example, has a 40-page flip book could show the 1, 5, and 10-year intervals on page 2 or page 39 and technically satisfy this part of the rule. But if a manager is going to do that, the manager also needs to be conscious of the fair and balanced requirement. And a manager that, let's say, showed 1, 5, and 10-year intervals on page 39, as I discussed, but happened to cherry pick really beneficial periods to show performance, a 7-year period or performance, how it looked coming out of the financial crisis up front and center in the book without making reference to the longer performance periods. While that doesn't violate this requirement, it probably is not fair and balanced and may not be consistent with the rule.
Well, and then it harks back to the prohibition of nothing, you know, not showing anything that it could appear to be misleading.
And I think that's a critical point to remember through all of this, that we're talking about performance and the presentation of performance in particular, but the general prohibitions still apply. You still can't say untrue statements. You still can't be misleading. You still need to be fair and balanced. So that's an overarching principle that is applied still through the presentation of performance. Even if you tick and tie each of these requirements, you still need to make sure you're not running afoul of those general prohibitions as well.
So I guess before we move on, is there, Mike, Linda, Lance, any other issues you want to sort of raise or identify here for folks? Okay, hearing none. So let's move on to the next one. So Mike, one of the interesting aspects of the new rule are some of the provisions relating to related performance, and as well as extractive. But let's start with related. What can you tell us about some of the issues here that you've been dealing with?
Yeah, so the term related performance is one that is new to the rule, and really what we're talking about here is if we're marketing funds, we're talking about the performance of any fund or separate account other than the fund that's being marketed. And if we're talking about marketing advisory services, we're talking about any fund or separate account when you're marketing advisory services. And the obligation here is with respect to all related portfolios of the advisor. If the advisor is going to show related performance, which is really any performance other than a fund that's being marketed, the advisor needs to either show the performance of all related portfolios, or may elect to remove one or more related portfolios or omit to show the performance of those related portfolios, only if that omission does not result in the performance appearing to be materially better. And there's a lot that flows from that. The first thing is, how do we exclude portfolios, right? We can exclude portfolios based on one of two theories. Our first theory would be that our portfolio is not real, that the portfolio in question isn't related, right? It's not representative of the strategy or the fund that we're trying to show. It wouldn't be meaningful to show a fixed income, the performance of a fixed income portfolio if we're trying to sell a large cap growth strategy, right? It wouldn't be meaningful to show the performance of a real estate fund when we're trying to market a private credit fund. And so what we draw from there is that firms are going to have a process for identifying which portfolios are related portfolios and which portfolios are just irrelevant to the investment strategy that's being marketed. I would strongly recommend that firms have that in writing. And in the adopting release, the SEC did make reference again to the GIPS standards and noted that the composite construction standards built within the GIPS standards would be an appropriate way, not the only way, but an appropriate way to approach the question, how do I identify what is and what is not a related portfolio? The next way that we can exclude portfolios from the presentation is by choice. We can simply say, for some reason, I don't want to include these portfolios. And I don't want to include them in a composite, or I don't want to include them if I'm showing all of the portfolios stacked up in a table. But if we're excluding those, the firm really needs to be able to substantiate that the portfolios that it excluded don't result in materially higher performance. And if you're going to do that, then I would, again, strongly recommend that managers have a written process where they define what materiality means to them and show that, at least on a periodic basis, that they test the exclusion of certain portfolios has resulted in materially better performance. And I would encourage them to keep records of that, because the practice of choosing, of simply electing to omit portfolios, is one way to produce misleading performance results. And I anticipate that the Division of Examinations will be looking at that very hard in the coming years. The final thing I think we want to touch on here is, what does this mean for representative accounts? And initially there were some concerns that this would mean that you couldn't use representative accounts, and that's not the case. A representative account would be viewed as a situation where all other representative or related portfolios have been excluded, and only the representative account remains. And that can be done as long as as the performance of the rep account is not materially better than if all had been included. Last point I will make, though, is if you are going to be electing to exclude certain accounts, that cannot change the reporting periods. And what that means is, if Lance has been managing a hedge strategy for the last 7 years, and he has 3 funds, and he's done very well in the last 5 years, and his first fund started 7 years ago, and his second and third started 5 years ago, he can't omit the first fund, because that's one way of omitting the older performance. He needs to show either the performance of the first fund along with the others, or just the performance of the first fund in that scenario, so that he doesn't change the reporting periods that are being shown.
Setting aside the fact that there's no way I would have a fund that performed well if I was managing it.
And is there something you want to add here with respect to related performance, or Lance?
Yeah, I was going to say that it appears to me that the documentation is going to be a really big piece of this this entire rule, and I think it's very clear here that it's going to have that what's related, what's been excluded, and why is documented and followed.
Lance, do you have anything you want to add here? Or?
One point is that the not materially higher standard was a change from the proposal, which was a big one. That it does allow for you to have more flexibility in showing rep accounts, which I think was a request from the industry, and a very big point. And the other point is that this is not we've got the interaction with GIPS. It's not inconsistent with what people are doing with GIPS. So if firms have GIPS processes for composites and for composite creation, you're probably in pretty good shape with respect to the new SEC rule.
Okay, so Megan, next slide, please. Mike, you want to walk us through extracted performance?
Yeah, absolutely. So the concept of extracted performance written into the rule is also relatively new to the SEC and to the literature here. And it's really actually very straightforward. The way that I would suggest people think about extracted performance is it's a carve out. it's a carve out or an attribution or a performance metric that relates to some subset of a portfolio. And I would note here that we need to be very clear and very precise that extracted performance is the performance of a subset drawn from one portfolio and only one portfolio. And we'll talk in a minute about why that's so important. Now, extracted performance is performance that might otherwise be treated as hypothetical performance because no one actually received the performance that's being shown. They received the performance of the whole portfolio. And as long as we're showing extracted performance, all you need to do is show the performance of the full portfolio or offer to show the performance of the full portfolio. And if you do that, you don't need to do all of the things that we'll talk about shortly that are required for hypothetical performance. The point that I think we really need to highlight here, and I think we can jump to the next slide and look at the high quality graphics that Linda, Lance, and I put together to make this point, is that if I have a crescent moon that is extracted performance, because it's a subset of the whole moon here, right? I can treat it as extracted performance as long as I am only showing that extract, right? Or actually, I guess you could say I could show the crescent moon and also, I don't know what you call it, right? The mostly full moon on the other side. I could show both of them on the page. I could show anything extracted from one full moon, and I treat that as extracted performance. Here is the problem. For those firms that claim compliance with GIPS, GIPS allows you under certain circumstances, if certain conditions are met, to take that crescent moon and treat it as if it's its own portfolio, to treat that carve out as a portfolio and to throw that carve out into a composite with other full portfolios or other carve outs or some combination of them. And as the rule operates here, we can't do that and treat that crescent moon as extracted performance in that case. Once we show that extract along with other portfolios and we build a composite out of them, the rule treats that as hypothetical performance information, which has a much more onerous set of conditions that need to be satisfied.
So thanks, Mike. So we've touched on hypothetical performance sort of throughout today. Let's go to the next slide, Megan, please. Lance, you want to talk to us about why we keep referring to this as a game changer for some firms?
Yeah, so the rules on hypothetical performance, remember, prior to this rule, hypothetical performance rules were gleaned from a bunch of enforcement actions. And so we saw what people did wrong and we adjusted to not do those wrong things anymore. But now we actually have real rules on hypothetical performance. And there's a few things that are good. There's a few things that are a bit more of a challenge. But the first thing we should think about is, what is hypothetical performance? General rule of thumb, it's any performance that's not actually achieved by client accounts, is what they say. So what this means is that seed capital strategies are not hypothetical performance, but they did go to some length in the adopting release to caution advisors that you shouldn't just use a de minimis amount of capital. You need to use enough capital to show that you're actually trying to do that strategy. So what's left of them? Well, hypothetical performance, I think we would all, yesterday, today, and tomorrow, agree that things like back-tested strategies would be hypothetical performance. And sure enough, those are in here. In fact, it was obvious enough that I didn't put it on the slide. But that said, there's some new additions that are interesting additions to the hypothetical performance family. And the first one is model performance. And this is performance like we would normally have advised on paper portfolios. And I think this is where that where that crescent moon and circle thing gets in there. This starts to become more of a model performance, and this becomes hypothetical. Before, I don't think we would have, or everyone would have treated this as hypothetical performance, but now it's clearly in there. And the next type is performance targets or projections. These are things that also weren't historically hypothetical performance, and still kind of, I think, stretch the natural language of hypothetical performance to include performance targets or projections. And it seems pretty onerous to say that these are hypothetical performance, but as we'll learn in a second, it may not be as bad as it first seems. But just to have a pin on it, a performance target is something like the portfolio seeks to achieve a return of 5%. That would be a performance target. Now that could be in your investment objective, it could be in your advertisement, it could be in different places. But the SEC looked at that, acknowledged that these are aspirational, and said that, yet they're still hypothetical performance because they have the opportunity to mislead. And same things with projections. If there's performance projections of where things would go, then that's something else that would fall into this hypothetical performance category. So what are the consequences of that? Well, one thing is that it plays around with the definition of advertisement. One of the things the SEC did from proposing release to adopting release is they allowed for communications sent to one person to not be advertisement subject to the rule. But they carved that out a little bit for hypothetical performance. So hypothetical performance is an advertisement if it's sent to one person. So anytime you're using hypothetical performance, you're in the world of the advertising rule or the marketing rule. There are a couple exceptions to that if it's a bona fide unsolicited request. And again, this is another one where they took great pains to explain that it has to be really unsolicited. You can't just wear a pin that says, "Invite, please ask me about my hypothetical performance." That's not gonna fly. So if someone just comes to you and says, "Hey, have you ever done a hypothetical performance of this?" Then maybe it works. But the recommendation there would be to make sure you document exactly why that is hypothetical or why that is unsolicited, because this is something that people are going to look at. And then similar to a prior exclusion, hypothetical performance provided to private fund clients in one-on-one communications is excluded. The grounding there is that they would have the ability to ask questions about their performance. I'm not really sure why that's different than an institutional client having the opportunity to do it in a one-on-one presentation, but there we are, it's in the rule. The last exclusion that is of note is interactive analysis tools. Things like portfolio modeling tools for retail investors are also excluded. The grounds there is that the anti-fraud provisions of the Advisors Act serve to protect investors enough that they don't need the additional protections of the marketing rule. So that's what hypothetical performance is. And if we could advance the slide, we'll talk about what it means when you have hypothetical performance. So there's 3 conditions that have to be met for an advisor to use hypothetical performance in an advertisement. The first is that you have to have policies and procedures to ensure that the hypothetical performance is relevant to the likely financial situation and objectives of the audience. You can figure out what your likely financial situations and objectives of the audience are by a lot of different things. You can look at their prior investments if you had an existing relationship with them. You can look at their net worth if you have that information, their status as a QP or not, whether they're an institutional investor, so on and so forth. But the thing here, and one of the game-changing elements, is that you have to do something. You have to identify them as someone who is financially literate enough to understand the limitations of the hypothetical performance and understand the systems that are used to create it. And so you're going to have an intended audience there. Another point is that there is going to be no mass distribution. They said this twice in the adopting release. So if you come away with anything about hypothetical performance, just know it can't go into a massively distributed advertisement. And then again,
that's putting it on your website.
Yes, no website disclosures, no blimp airdrops, none of that. Don't put it in skywriting. You need to target it to a certain audience and understand who that intended audience is. And then again, trap for the unwary, document and record keep who that intended audience is. The next thing is disclosing your criteria and assumptions. This is still principles based, so it's another one of those things that creates a little bit more of a burden from the compliance standpoint. So you have to understand what the criteria and assumptions are and what disclosure is relevant to those investors. And it does allow for a little more latitude in things like model performance, which again used to not be hypothetical performance, now is. But they did specifically note again that if model performance was very simple and not likely to mislead, you may subject it to less stringent policies and procedures than other types of hypothetical performance. Think back testing. It also gives a window for those performance targets. That was another example they used, where if you just say, I have a performance target of 5%, you still disclose your criteria and assumptions, but you may disclose that 5% is not based on any criteria and assumptions. It's what I hope to achieve. So you have a disclosure requirement, but you can meet it fairly readily. The last of the 3 major requirements is that you need to disclose information to allow audience to understand the risks and limitations of this. this is where you need to describe all the conditions about the hypothetical performance, its limitations. One example that I thought was notable was if your hypothetical performance was actually run 1,000 times and you picked the best performing hypothetical performance to show, that's something you want to disclose to investors. So it's not just about the hypothetical performance itself, but about hypothetical performance generally and how you landed on that particular one, in addition to the assumptions. Now, you're not necessarily required to disclose all the information an investor would need to recalculate the performance on their own. That was a standard floating around out there for a while. But you are required to show enough information that an investor would be able to understand all the risks and limitations. Again, another one of these principle-based things that is a nice gift from the SEC, but also a new compliance burden. And so lastly, I've touched on a little bit of this, but your record keeping requirements are still applicable. You'll need to record keep all this information, including the information based on how you calculated your hypothetical performance and who your intended audience is. So with that, I'll see if there's anything else from my fellow esteemed panelists that I may have missed or we may want to add.
So
I'm sorry, go ahead, Linda.
Yeah, I was just going to make a comment that to me, it's very clear that this is saying, don't do this to the retail market. Do both of you agree with that? Lance, do you agree?
Yes. Yes, it's almost impossible to do it to the retail market if you're going to have to qualify everyone at a certain financial sophistication and almost do it individually or at least by categories. And just saying retail market is okay, I think they were very clear that they don't think retail market is the right consumer for hypothetical performance.
Yeah.
You want to
Lance, there were a couple of questions that came through on the chat, and I know we're not doing a lot of questions here, but I think that they would be worthwhile to address because I think they'll be illuminating on some of these points. So I'll ask you if you don't mind some of these that came through. We've heard varying opinions on this, so I'm curious to hear your opinions. Would you view Monte Carlo simulations as hypothetical performance?
I think that would depend on how they're used. If they're used as an indication of the performance of the strategy, then absolutely. And that might actually come into one of those situations that I mentioned before, where you'd need to disclose the limitations being, we ran this 100,000 times, and here's what the outcome was. But if it's used as a tool, a part of the actual investment management process, then that may not be itself a hypothetical performance for the strategy. So I think you'd want to look at how it's used, and if it is used in a way that's indicative of the performance of a strategy, then it probably falls within the hypothetical performance criteria.
I absolutely agree. Next one. If you pull extracted performance from a number of funds, like all of your ESG investments based on some criteria, is that not allowed if you show all of the investments of the multiple funds you've drawn from, or is that okay?
So I think that gets back to the little moons.
Well, it gets back to moons, but here, we get back to our moons. I think here that it's not that this is not allowed by any means, but rather than being viewed as extracted performance, it would be viewed as hypothetical performance and would need to be treated in the same way as really as a back test, right? According to all of the conditions that Lance just described.
So we only have about 5 minutes left. I want to make sure at least we touch on the last topics, but before we do, our last word for CLE is calm. So stay calm. We'll all get through this. So calm.
Sanjay, before we go, there is a question that I want to make sure we answer. There's a question in the audience about can you post it to your website? I'll just say that I would caution you against doing that. I think that posting it to your website, you start to lose control over who has access to it. If you have strong controls to ensure that only certain people have access to that, then maybe you'd think about it. But you're starting to push on the limit of what the SEC is looking for here, and I'd be very wary of posting any hypothetical performance on any mass distribution medium.
Great. So next slide, Megan, please. Next slide. So Mike, do you want to walk us through some of the new provisions relating to predecessor performance?
I do, yeah. I have not seen the slides move, but we'll move on it anyway. So the what we used to call portability and refer to as predecessor performance really addresses the question: what do I do if I have hired a team of investment managers, or portfolio managers, or investment professionals from another firm, or even if I've merged with another firm, and I want to show the performance that was produced by these individuals but it wasn't performance that was produced by my investment advisor. And this is an issue that historically has been addressed by the SEC staff in the form of staff no action letters. And the staff has provided no action relief that essentially says you may show the performance of other people, of other advisors, if certain conditions are met. And those conditions historically have been more or less that you need to have the same people, the same process, and you need to have all of the records that are necessary to be able to substantiate the performance that is being shown. And I'm summarizing this significantly. Now we run into an issue where the rule, the new marketing rule, restated pretty close, made a very close restatement of the standards that had been established by the staff in that no action relief. But that was done without any meaningful comment from the industry essentially because that proposal was not built into the original proposing release. And in doing so, several questions have come up that right now are more or less open. The first issue is, what does it really mean to have the same people? In the adopting release, there's a concept that a substantial identity of a team, if you're not talking about one person, but a team that came over, that a substantial identity of the team must continue to manage assets at the new advisor if you are going to be able to show the performance of the team from the predecessor advisor. And that means, in essence, that you will not be able to show the performance of the predecessor advisor if there is so much turnover on that team that you no longer have a substantial identity. Does that mean more than half? Does that mean half or more? Does that mean everyone? How do you treat portfolio managers versus investment analysts? I don't have answers to that because it's really going to be a facts and circumstances analysis based on each individual situation. Another big issue that comes up is the status of other no action relief that now, as of last Friday, I believe, has been rescinded, that talks about moves within affiliates. And there's a real concern here because when affiliates merge together or teams move within the affiliates, that has historically not been considered a situation that should cause the new affiliate to lose the ability to show performance. Under the current state of affairs, when a recent no action letter has been now withdrawn, rescinded by the SEC staff, that's no longer clear. The former no action letter had said that when teams move among affiliates, they could treat the performance as if it had been shown, or as if there had been no change in the advisor. Under the new rule, it appears that the same rules for unaffiliated advisors apply to affiliates. And what that means is if two advisors merge together, even if they were under common control prior to the merger, and then there is turnover on the investment team, that the resulting advisor may lose the ability to show the historical performance of one of the predecessor advisors. I don't know if that was an outcome that was intended by the authors of the rule, but it's an issue that particularly large organizations with multiple advisors are going to need to keep an eye out on. Linda, Lance, any other thoughts on this issue? Recognizing we're short on time.
Nothing here. I think you covered it well.
Yeah. So thanks, Mike. So next slide, Megan, please. So actually the next two slides sort of walk through some of the new record keeping requirements and some of the ones that are sort of similar. And I know, Linda, you were going to walk through that, but I do want to make sure we touch on the Form ADV because that's a question I get a lot on. And I don't think it's really addressed. Could you just focus on a second on the new Form ADV requirements and what exactly that is?
Sure. So in the first annual updating amendment after November 22nd, 2022. So for most firms, it's going to be the March 2023 annual amendment. There are new questions on the ADV, and they start with, are you going to be advertising performance? And then they go through are you advertising extracted, related, hypothetical, and you have to answer yes to the ones that you are using for advertising. And it's going to raise your risk In terms of the SEC, because we heard earlier that they're gathering the data points from all the ADVs to determine who's going to be examined for what. So just be aware that these questions will be answered on the ADV by no later than March 2023. But you can certainly begin converting to the modernized rule before then, and until the questions actually show on the ADV, you won't have to respond. So does that make sense?
Yeah. Okay. Megan, you want to take us to the last slide? So unfortunately, we're at the end of our time here, and we're going to immediately transition into the Ask the Experts panel. And I know we got a lot of questions that we weren't able to address, so please take those questions to one of the two sessions that we have and ask them there. But I want to thank Lance, Michael, Linda for being here with us today. Their contact information is here, and I'm sure they'd be happy to answer any questions. If this was live, you could come up to the stage and talk to them. And unfortunately, that's not something we can do now. But thank you guys so much for doing this and offering your perspectives here today.
Thank you for inviting us.
Yeah.
Thank you.
So we have two sessions, breakouts. One is going to be for large firms. One is going to be for smaller firms. You pick which one you think makes most sense for you. And I'll see you guys in a minute. I think we're going to transition over. So thank you, everyone. Take care. Bye.